Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the best stocks to buy right now. So you've heard the term buy the dip, but now we're actually talking about which stocks to buy this massive dip on. These stocks can literally double, triple, or even quadruple your current portfolio, so this is going to be a very good video for you to watch all the way through. Don't forget to comment your thoughts down below. If you want more videos like this one, smash that like button right now, and subscribe if you are new, but now let's just get right into the video. So buying the dip is a very simple strategy overall. However, many investors should be somewhat cautioned because this does need to be done right. You need to buy into companies that have strong fundamentals and strong growth prospects. So if you don't want to buy individual stocks, I normally like to invest and dollar cost average into ETFs such as VOO and VTI, and that's how I personally buy the dip, by dollar cost averaging every 2 weeks into those ETFs. However, if you want really good gains by taking on a little extra risk, these stocks in this video are going to be the ones for you. These are not going to be short-term plays because the whole point of these companies is to compound their growth over time. So overall, in the next 5 years, they are going to outperform the majority of other stocks on the market and the market itself, which is why this Forbes Advisor article has identified 9 cheap stocks to buy right now that have fallen along with the S&P 500 but are set to drastically outpace the overall market in the long term. We are going to identify companies that have a multi-year history of growth, very strong earnings, fantastic revenues, and these companies are all backed by very bullish analysts. So now I'm going to highlight the criteria we have for these particular companies that we are about to go over. So first, we want all the stocks in this video to have at least delivered 5 consecutive years of an annual earnings per share increased at a growth rate of around 15% per year. Then after that, we want to make sure that they have sustainable revenue growth. Also, we want to hone in on the profitability of these companies because that is very important, especially during times of stock market volatility and when the stock market is crashing and or falling. So we're going to make sure that they don't have a negative EPS at least for the last 4 years, so they've been somewhat profitable over a decent period of time. We also want the returns of these companies to beat the overall market. So one of our criteria is we want to make sure these companies are giving us more money than what the S&P 500 could give us in return. So instead of investing into VOO or VTI, we actually want these companies to outperform the overall market. And then lastly, we're going to make sure that these companies have dropped in price recently, so we know we are buying the dip into good companies. So the minimum drop we want to see is a 20% drop from their recent highs, and this is not only going to verify that we are getting a good deal on these companies, but it's also going to help us ensure that the long-term growth prospects of this company are absolutely phenomenal. And to start off our list, we're going to talk about Monolithic Power Systems Inc., ticker symbol MPWR. Currently, this company trades for around $390 per share. However, analysts think this company is worth anywhere between $500 and $630. So clearly, the company is undervalued according to analysts. This company, according to this Forbes Advisor article, is a company that manufactures integrated circuits, and it's used to manage power in various electronic systems. Manufacturers install Monolithic's chips to help reduce electricity consumption in their systems. So overall, this is a very good company that many companies are going to continuously utilize in the future. If we look at this company historically, in the last 5 years, the share price of this company has jumped by a total of around 373%, and the company has currently dropped by around 20% since its all-time highs. So in my opinion, this is going to be a phenomenal buying opportunity to buy the dip on this very fundamentally strong company. And if you want to see some of the fundamentals, those can be located up here. But I don't want to spend too much time just on one company because we have a lot of good companies to go through in this video. If I'm going too fast for you, feel free to pause the video and read some of the other information that we have on this particular company. I also want to say that this company offers a dividend yield to its investors of 0.7 11%, which is absolutely phenomenal, because during times of stock market uncertainty and volatility, investing your dividends back into the company that gave you them, which is going to be a drip investing strategy, has been known to really bolster and fortify a portfolio during a time when the market is downtrending. And they have actually increased their dividend payout every year since 2017, including the year of 2022. So overall, this is a phenomenal company to have in your portfolio, or at minimum, put this company in a watch list. Now, next to these companies, I either have a check mark or an X mark. So the check marks are the companies that I personally own, and the X mark are the companies that I don't own. They're just sitting on a watch list. Because the next company we have is currently on my watch list because I think the company could continuously fall further down in their price. And that company is Ubiquiti Inc., ticker symbol UI, and it currently trades for around $245 per share. Negative analysts think that the company is going to fall below or around $196 in the next 12 months, while bullish positive analysts think that the company is going to be worth around $345 in the next 12 months. So clearly, I would actually tend to agree more with the bearish analysts that says that the company could actually continue to fall in the short term. However, this is not to say that the company is not a good long-term buying opportunity, because even if you buy it at its current price point and you're willing to wait a few years, the company is going to scale very dramatically, which is absolutely fantastic. The article goes on to say that Ubiquiti operates wireless and network equipment for internet service providers. The communication equipment company has been growing annual earnings and total revenue since 2018, end quote. So clearly, that is absolutely fantastic to know about this company. What's even more impressive in my personal view is that the shares have grown by around 470% over the last 5 years. And if we compare that to, say, the overall stock market would give us returns of around 50% in the last 5 years. So overall, this company is absolutely phenomenal. UI is currently trading at a discount of 30% when we compare it to their March peak back in 2021. And to add even more gasoline to the flame, they also have been increasing their dividend payout ever since 2014, and their current dividend yield for investors is 0.9%. So again, this is a phenomenal growth company that also offers a strong dividend. So whether or not you're a growth investor or a dividend investor, this is a perfect hybrid company in my personal opinion. Next up, we have one of the best stocks on the stock market that you could possibly buy, and that's Microsoft Corp, ticker symbol MSFT, which currently trades to close to $247. Analysts are extremely bullish on this company, and even the low-end analysts that have lower price predictions and price targets still think that the company is undervalued right now, while the high-end price target actually goes as high as $500 per share. And if you don't know what Microsoft does, they do almost everything. They have personal computers, and they have software that the majority of businesses use. So not only does Microsoft sell to the everyday consumer, but they also have a lot of business coming from other businesses, because the majority of businesses, in my view, actually use some sort of Microsoft product. And I want to add that this is a phenomenal blue chip company, which means it's an extremely safe stock, and buying the dip on this particular company is what I am personally doing. Over the last 5 years, the company has returned to its investors growth of around 300%, which is absolutely astonishing. And this is despite a recent pullback in the stock price of around 22% when we compare them to their all-time highs. So to me, this is a no-brainer buying opportunity to buy the dip, especially considering the current stock market environment, and because this is a phenomenal safe growth stock to buy overall. If we don't include Microsoft's dip in 2020, this is literally the largest decline in the MSFT stock since 2010. I also want to point out that they also have been increasing their dividend yield for over the last decade, and they have a current dividend yield right now of 0.9%. So again, you are getting phenomenal growth, great safety, and a decent dividend yield for a growth stock. The next company we're going to be talking about is Chipotle Mexican Grill Inc., ticker symbol CMG, and the current stock price is $1,235 per share. Now, if you're watching this and you don't have $1,235 to invest into an entire share of CMG, I would encourage you to look into a brokerage that offers fractional shares, which means that if you have at least $1, you could buy a fraction of a CMG share, despite the current stock price being $1,235. So remember that. Make sure that your brokerage or the platform that you are using to invest into these companies or stocks allow either share slices or fractional shares. The current stock price for CMG, analysts agree almost unanimously that the company is clearly undervalued right now. If you didn't know, Chipotle is a fast food restaurant chain, and naturally they sell Mexican food. The company has had very good growth over the last 5 years of 189%, and again, anything above 50% is going to be a company or stock that is outpacing the overall stock market benchmark of the S&P 500. Now, I do want to say that this company has been known to have very large drops. For instance, in 2012, the company's stock price dropped by around 47%, and the company fell by around 65% between 2015 and 2018. It also dropped around 55% in early 2020. So this company is known for major drops. However, I think we should take advantage of these drops, especially if you are a long-term stockholder, because this could be a fantastic entry point for either starting a position or averaging down your average costs for this company. The current company is trading at around a 30% discount, which is to me a phenomenal opportunity to buy the dip in this company. However, the CMG stock does not offer a dividend for its investors. It's mainly focusing on growth, and instead of giving a dividend to its investors, they are just reinvesting anything from the company back into the business, and that's why they don't have a dividend. The next company that we have is ASML Holding NV, ticker symbol ASML. The current stock price for this phenomenal company is $468 per share, while the range for analysts' price targets and price predictions go anywhere between $610 and $1,030 per share. At least these are the 12-month analyst price predictions. And again, because the current stock price is substantially below these two price targets, clearly the company is undervalued. This company is a foreign company because it's based in the Netherlands, and they design and manufacture machinery that is used by other companies that make microchips. Some of the company's major clients would include companies like Samsung Electronics, Intel, and Taiwan Semiconductor. So clearly these are very prominent clients for this particular company. I also want to say that the company has decreased in their stock price by close to 37% from its all-time high. So to me, again, this is another no-brainer buying opportunity. Also, analysts currently project that the next 5-year growth forecast for this particular company in terms of their earnings per share and their revenues as well as their stock price are going to be absolutely mind-blowing. On top of this, even more good news is that they offer a dividend yield to their investors of 1.1%, and they have increased their dividend for over a decade. So clearly that is continuously going to increase, and overall I am very bullish on that particular company. The next company that we have is Deckers Outdoors Corp, ticker symbol DECK. The company currently trades for around $248 per share, which again makes it a phenomenal buying opportunity if we compare that to what analysts think that the stock is worth right now. And as you can see, the price targets range anywhere between $292 on the low end to $519 on the high end. And this company is most notably known for manufacturing and selling apparel and footwear. The company has drastically dropped in their stock price by around 40% from their all-time highs, and I think this company is absolutely phenomenal because in the last 5 years, it has grown their investors' wealth by around 281%, which is absolutely astounding. I also want to say that for such a crazy growth company, this company has a very competitive price-to-earnings ratio, or a PE ratio. So normally, investors for growth stocks are willing to pay a higher PE ratio because they are betting on the future success of the company over a long period of time. And to me, the company has a very attractive forward PE ratio of only 14.06. Now, the only downside of this company is that it does not pay a dividend as of right now, but honestly, I wouldn't want to because clearly I want them to use any extra cash that they have to reinvest it back into the company, especially as it continues to scale their earnings so they can keep getting that PE ratio even further down, which could eventually attract value investors instead of growth investors. The next company we have on this list is Medifast Inc., ticker symbol MED. Currently, the MED stock price is $178, while the analysts that cover this company currently say that the company is worth anywhere between $285 per share and $352. Now, what I actually don't like about these price targets is that not many analysts are currently covering this stock. Also, these analyst price targets we do need to take into consideration, and we should take these with a grain of salt. Analysts can't actually project what the company will be worth in the next 12 months. These are just guidelines that we as investors can look at to determine what the stock price could be based on various estimates. This company is most known for producing and selling weight loss and healthy living products, and I think these types of products are going to gain even more traction as time goes on. The stock is currently up around 346% over the last 5 years, which again is absolutely crazy. You're literally tripling your money in just a 5-year time span. And if you don't think that's impressive, literally you probably don't know how the market works, or you haven't been in the stock market long enough, because that is absolutely insane. To make it even more insane, this is despite a 50% pullback from its stock price when it was at its all-time high back in May of 2021. The company has also tripled their revenue since 2018. And they also offer investors the highest dividend yield of any company currently on this list, coming in at 3.6%. So if you are a dividend investor, this company literally is screaming at you to buy. Also, they've increased their dividend every year since 2015. So clearly that dividend is set to increase even further as time goes on. The next company we have is Intuit Inc., ticker symbol INTU. The current stock price for the INTU stock is $369 per share. Now, I personally love this company, and analysts do too, because clearly they think that the company is drastically and dramatically undervalued right now, which is fantastic for long-term growth investors. The reason why the stock price is so low is it's fallen by around 50% since its all-time highs, so clearly I personally am buying the dip on this company. Analysts think that this company is worth anywhere between $450 to $652 per share in the next 12 months. I also want to make you aware of what this company does. So this company makes accounting and tax software. And although you may not be familiar with this company, you are probably familiar with QuickBooks and TurboTax. So these are its two main products that this company owns. I also want to highlight that their earnings per share and their revenues are set to absolutely be dominant in the market as time goes on. And lastly, for this company, I want to point out that they have a decent dividend of 0.7%, and they have increased that dividend over the last decade. So again, this is a phenomenal hybrid growth dividend stock that has phenomenal growth, but it's also growing their overall dividends. Now, the next company we're going to look at is EPAM Systems Inc., and the ticker symbol is EPAM. The current share price is $291 per share, and analysts think that this company is worth anywhere between $370 to $771 just in the next year. This Forbes Advisor article defines EPAM Systems as a software engineering and design firm that serves companies across industries in more than 45 countries worldwide, end quote. So overall, clearly this is a blue chip company. I also want to highlight that this is probably the most discounted stock on this list because they are down as much as 76% from their all-time highs. But yet the company has still returned phenomenal stock price appreciation for their investors of 311% over the last 5 years. So despite this very radical decline in their stock price, the company is still firing on all cylinders. The company also has very sustainable revenues and very impressive earnings per share growth over the next 5 years. At least that's what's projected by analysts. However, EPAM does not currently pay a dividend, but to me it doesn't even matter because this is one of the best growth stocks to buy on this list. But I would love to hear in the comments down below your favorite growth stock or your favorite growth hybrid dividend stock that you are investing into right now. What's your plan for the current stock market volatility that we are seeing in the market? And if you want more videos like this one, remember to go and smash that like button right now, share this video with your friends, subscribe if you are new, and I'll see you in the next YT video.